Hi, good evening, friends. Welcome to the latest edition of Passive Speak. Today, we will be covering the launch of a new fund, which is HDFC Nifty LargeMidcap 250 Index. So, this index basically is a combination of the large cap index and the mid cap 250 index. So, India, as you know, is a great investment opportunity for many years to come. That is because it's one of the fastest growing large economies in the world. Uh, the capex recovery has started, which was first led by the government, and now the private sector is also contributing to the capex. Infrastructure, what you call creation in India, is at never before seen level, whether it's roads, railways, new airports. So the infrastructure momentum is also very strong. Reforms momentum continues. The present government has been in power for last 10 years. So the reform process has been there uninterrupted. As a country, we are very rich in natural resources. Uh, and currently, there is a global shift in global manufacturing, which is favoring India as people are now moving away from China and they are looking for alternatives. So India is well placed to get a good share of that global manufacturing volume here. Our demographics are very favorable, where our average population age is quite young, and the availability of skilled English speaking and young manpower in India is far more than in countries with this size of population. And of course, the income levels have been rising, and the penetration of white goods or consumer goods is still pretty much low as compared to consumer durables as compared to the developed economies. So we have a long runway of demand for aspirational items as well. So as we are covering the two market cap segments in this product, one are the large cap companies. Those are the 100 largest companies by market capitalization, which is the Nifty 100 index. These are the top 100 stocks in India. And then that is followed by the next 150 companies, which are also referred to as mid-cap companies. They form part of the Nifty Mid-Cap 150 index. So the scheme, as the name suggests, Nifty Large Mid-Cap 250 index includes both these top 100 companies as well as the next 150 companies. So, what are the attributes of a large cap company and a mid cap company? Large cap companies are the top 100 companies by market cap. They generally are very well established businesses. They are mostly market leaders in their segment of business. The businesses are relatively stable and subject to lower volatility as they are established businesses, and they have had the experience of going through many business cycles over multiple years. The key sectors within the large caps are financial services, IT, and auto. Mid caps are the companies from 101 to 250. These are mid-sized companies, and most of them are the future leaders as they grow in scale and size. And the volatility in mid caps generally is higher as compared to large caps. The key sectors in the mid-cap segment are NBFCs, industrials, and auto ancillaries. Uh, but if you look at this slide, basically, a leadership position can either be in a large cap company or a mid-cap company. Just for example, in consumer finance, the largest financer of consumer durables is a large cap company. In construction and engineering, India's premier infrastructure developer is a large cap company. In the food retail segment, the leading supermarket chain is also a large cap company. And in metals and mining, the leading mining company is a large cap company. In mid caps, basically, there's a personal product company. It's a multinational FMCG company. It is a leader in oral healthcare products, and it is a mid cap company. In tires and rubbers, India's largest tire manufacturer is a mid cap company. In auto parts, India's largest battery company is a mid cap company. And in application software, there is a leading global design and technology service provider, which also happens to be a mid-cap company. Now, this slide, basically, we have made a comparison between the Nifty 100 Total Return Index and the Nifty 150 Total Return Index. We have taken the data for the last 19 years. The last year is FYTD. So these are the financial years that we have taken. So as you can see in this chart, there are certain years in which Nifty 100 does better in terms of returns in that particular financial year. And there are certain years in which the Nifty Midcap 150 Total Return Index does better. So there are 8 such instances where the Nifty 100 TRI has outperformed the Nifty Midcap 150 TRI. And there are 11 instances where the Midcap 150 TRI has outperformed the Nifty 100 TRI. So what the message of this slide is that winners among large caps and mid caps keep changing. So taking exposure only to one is not enough. It makes more sense to have exposure to both large caps and mid caps in your portfolio. Now, I would like to hand over the presentation to my colleague Siddharth. He will take it forward.
Yeah, hi. So just to sort of take it ahead on the methodology of this index. This index is a very clean and neat mix of the Nifty 100 and the Nifty Midcap 150 index in a 50-50 weightage. So what the index does is that every quarter you keep rebalancing between Nifty 100 and Midcap 150 in case one of the indices run ahead of the other. And the benefit of this strategy is that, and we will sort of understand this in more detail, but every quarter, this weight rebalancing happens, that where a large cap outperforms or where a mid cap outperforms, the weight is brought back to 50%. Alongside, every 6 months, the index also churns between new large caps and new mid caps within the indices. And stocks that are no longer large and mid caps move out of the index, both the mid cap 150 index and the Nifty large mid cap 250 index. As a result, what we see is that as a result, what we see that the index fundamentals, are also a mix of the two. For example, currently where mid caps have run up significantly and have a price to earnings ratio of 44, this index, which is a mix of the two, is somewhere in the middle with just about 31.5x PE. Similarly, on the PB side, also you see that it's a roughly average between the two. In the top 10 constituents, and what you will see is that this index therefore becomes far less concentrated than the Nifty 100 index or the Midcap 150 index, both at the stock level and, as you see here, even at the sector level. The sector level slide actually provides a lot of interesting insights. For example, where the Nifty 100 index has a very strong weight to financials at about 31%, it is not present in segments such as textiles, media industries, right? Being equally allocating towards large cap and mid caps, this index, the Nifty Large Mid Cap 250 index, provides a very holistic exposure to India's established and emerging companies with a weight towards across sectors in the Indian economy, and no sector getting a very large weight. Financials, which is extremely large in Nifty 100, gets a moderately lower weight of 24.5%, and sectors such as information, IT, capital goods, auto, healthcare, oil and gas all get a reasonable bump up in their overall weightage in the index. In all, you get about 20 sectors for which exposure is provided through this index. Being a function of the 50-50 weightage, what we also see is that the performance for the large mid cap index falls somewhere between Nifty 100 and Nifty mid cap mid cap 150. The current 1-year return for the Nifty Large Mid Cap 250 index, the TRI version, is 44.2%, whereas Nifty 100 and midcap 150 are at 38.3 and 50.1 respectively. So because currently mid caps have run significantly ahead, what we see is that mid caps have outperformed large caps across time horizons. But as we have seen in the past, there are, and as Sandeep also highlighted, that winners keep changing. In some of the years, large caps or the Nifty 100 has outperformed, and in some of the years, mid cap 150 has outperformed. It becomes very easily sort of visible in this FY performance slide, where out of the last 19 financial years, in 19 years, large caps have underperformed, or rather, mid caps have outperformed. And in those years, the large mid cap index has also outperformed the large cap index. Similarly, in years where large cap has outperformed, that is 8 out of these 19 years, we see that large mid cap index outperformed the mid cap index in those years. So investing in the large mid cap 250 index provides 50-50 exposure, and therefore it sort of balances out between both the indices. As a result, on the rolling return sort of summary as well, right, where we have summarized 1 year and 3 year rolling returns over the last sort of 19 years, what we see is that while both the Nifty 100 and Midcap 150 index have healthy average returns over these past 19 years. So, for example, over the 1 year, Nifty 100 has about 17% and Midcap 150 has about 22.1% average return. This index provides you somewhere in the between, that is 19.5%. As a result, what we also see is that volatility is also somewhere in the middle. While large caps have been relatively less volatile, 24.7% standard deviation, mid caps have been far more volatile. So investing in the Nifty large mid cap 250 TRA gives you a result that's balanced and somewhere in the middle, right? Obviously, this slide also serves as a good reminder that as you move towards the long term, while index returns remain relatively stable at about 14 and 14 odd percent, your volatility numbers drop significantly. So also again serves as a reminder that within equities, staying invested for the long term is a beneficial trait. To speak more about the fund, I will invite Sandeep to join in. I'm back.
Thanks, Siddharth. I think now Siddharth has taken you through the finer points of the presentation. We would just like to again summarize the key points in the presentation. So why should one invest in this Nifty large mid-cap 250 index? The key points are you participate in the India growth story because the largest 250 stocks you're getting exposure to in a single product, which covers various companies of various sizes, both mega caps, large caps, mid caps, various sectors are covered, as we showed in the sector allocation. The winners keep changing between large caps and mid cap indices from year to year. So through this one product, you will get a allocation to both large and mid caps in a single product. And large caps provide the stability in the portfolio because of lower standard deviation, and mid caps basically give you the potential for bigger capital appreciation. So they kind of complement each other. As our tagline says, you are participating with the established and the emerging. So the best of both worlds is what you can say is what you get in one single product. The other reason is that because the rebalancing happens at the fund level, that is more tax efficient rather than the investor selecting one large cap fund and one mid cap fund. And he keeps changing his allocation as per the change in the overall allocation here, because the 50-50 allocation has to be met by the fund, which happens every quarter. This happens at the fund level, so it is much more tax efficient to invest directly in this fund than the investor taking exposure to large cap and mid cap segments separately. The fund is the index fund, so it is run at a much lower cost, both in the direct and the regular plan. So for long-term investment, this fund is ideally suited. A bit about HDFC AMC on the passive side. So on the passive side also, we are a trusted name. where we've been managing index funds for 20 plus years now. We have a wide range of products. So we are one of the largest funds across several categories. Both Nifty and Sensex are very large in size. We have the largest small cap ETF category also in the industry. So as can be seen that we have a very good track record of managing a lot of index funds and ETFs over quite a long period of time. About this fund, basically this is fund will be index fund will be replicating the Nifty Large Midcap 250 index, and basically the objective is to replicate that performance before fees and expenses. And the fund managers for this fund would be Nirman Murakhya and Arun Agarwal. The benchmark for the fund is the Nifty Large Midcap 250 index. There is no exit or entry load in this scheme. The minimum amount is 100 rupees for initial purchase and any amount thereafter. And so I think that's what we wanted to cover about this product. So thank you very much for your participation in this webinar, and hope you will consider this fund for investment. The NFO starts on 20th September. So it will be available on all our digital platforms as well as the digital platforms of all our partners. And also one can invest offline through any of our branches. Thank you very much, everyone. That's it for today.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.